This morning on the Ag Issues program, a pleasure as always to bring on to the program Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine. Good to be with you.
Good to be with you as well. And let's get to it. Before some of the main topics of discussion we're going to have, of course, a lot of the talk has been on tariffs, to say the least, with not only news last week, but obviously news over the weekend concerning President Trump's trip to Asia, that he currently right now is in Japan, obviously with the here later in the week going to South Korea at the APEC summit.
Mm-hmm. Yeah, well, we've got the case that's pending before the U.S. Supreme Court, and argument's going to be, it's scheduled for next week. We'll see. I think it's late in the week. What is it, November 5 that's scheduled for? So that's coming up pretty quick. But the core legal battle there involves a challenge to tariffs imposed under the International Emergency Economic Powers Act, or the IEEPA. And those tariffs are exceptionally broad. They cover a vast array of imports from lots of countries, and they're often referred to as reciprocal or trafficking tariffs. And the administration lost in the courts below in the federal circuit because that circuit ruled that the president had exceeded the authority granted by that act when imposing those tariffs, and basically found that the IEEPA, which grants the president emergency powers, doesn't provide a clear congressional authorization to impose tariffs on a very vast economic and political scope. I have some issues with that because if it is true that under Article 1, Section 8 of the Constitution, Congress has the power to collect taxes and duties and imposts and excises, but 6 times since 1930, Congress has legislatively delegated that power to the president. And that allows the president to impose tariffs on 6 different upon 6 different conditions. One is if the imports threaten or impair national security. That's the Trade Expansion Act of 1962. 2, if they cause or threaten serious injury to a domestic industry. That's the Trade Act of 1974. So the president can impose temporary import restrictions, including tariffs, to protect the domestic industry from sudden and significant surges in imports. Third, the president can respond to actions that violate trade agreements and that discriminate against U.S. commerce or impose an undue burden on it. That's also the Trade Act of 1974. Those are the 301 tariffs. And fourth, the president can impose tariffs to address serious balance of payment issues. That's also the Trade Act of 1974. That's Section 122. The 5th grant from the Congress allows the president to impose tariffs on countries that are engaged in discriminatory practices against U.S. exports. Those are your 338 tariffs, Section 338 tariffs under the Tariff Act of 1930. And then finally, the Congress says that the president can take actions to respond to unusual and extraordinary threats to national security, foreign policy, or the economy during a declared emergency. And that's the IEEPA. And so that gives the president pretty broad authority. And with each of those actions, Congress has provided the president with an intelligible principle to guide their actions, which satisfies the constitutional requirement. So I think the lower court got this wrong. I would anticipate a close opinion in the Supreme Court. I think he gets 5 of the 6 justices that have something to say on this. But this is, again, keep in mind, this is not a constitutional case. This is a case involving statutory interpretation. And that's a key point to keep in mind. It was, about 10 days ago that Justice Barrett came out, and the media picked it up and kind of set a firestorm amongst people who don't understand what she was saying. But she said, we don't have any way to enforce our opinions, which is true. And what she's telegraphing there is, in this tariff case, they're not ruling on constitutionality. It's on statutory interpretation. That doesn't carry a whole lot of weight. It's just, while the Supreme Court doesn't issue advisory opinions, this is about as close to an advisory opinion as you're going to get, because they're just ruling on statutory interpretation. They'll say, well, we think it means this. The president's attorneys, if he loses, will say, thank you very much. We think it means this. and then it kicks it to Congress to clarify what the statute means. But even if the administration loses the case, that doesn't mean all tariffs are gone, because you're only dealing with the IEEPA tariffs. Your Section 301 tariffs on China will stay. Your Section 232 tariffs will stay. Those are your tariffs on medium and heavy-duty trucks and parts. And you've got other types of tariffs that will stay, too. So the Supreme Court has got to realize that if they invalidate the broad IEEPA tariffs, the reciprocal tariffs, the trafficking tariffs, that'll negatively impact the bond market, particularly U.S. Treasury bonds, through two main channels. It'll cause increased inflation and higher Treasury yields, which will be negative for bond prices. And that's because tariffs are a tax on imports, Greg, and they're often passed on to consumers and businesses that contribute to inflation. Well, if you invalidate a large swath of tariffs, that would have the opposite effect. So you'd have a disinflationary shock. The Federal Reserve would react to that. That'll reduce the need for the Fed to maintain or raise interest rates to cool the economy. And in the bond market, you'd have falling yields because a disinflationary shock and the prospect of Fed rate cuts would typically cause your bond prices to rise and their yields to fall. And so that negative impact would arise if the ruling is interpreted as removing an important check on presidential power to address economic and national security issues, or if the markets had already factored in lower inflation. So you'd also have a heightened political and economic uncertainty and risk, which would again be negative for the U.S. bond market. And that I think is more significant, and it's nuanced, but it's a negative impact for the bond market, particularly for U.S. Treasuries as the world's safe haven asset. So this is a big opinion, simply because of the impact it could potentially have on the market, but not on a constitutional case. They're not ruling on the constitutionality of the 1974 law. What they're ruling on is what the words in the statute mean.
I'm curious how quickly, once the case takes place or once it's presented in the Supreme Court, how quickly do you think this decision will come down, knowing the scope of the decision and the current situation right now?
Quickly. I think they probably already decided it, and they're just waiting for the oral arguments to maybe address some lingering questions that are there. But I think it's largely done. And probably the opinion would come out sometime before the end of the year. So I think it'll move pretty quick.
All right. We need to get on to other topics of discussion. That's good. That's great to get an update on that. One of the things, or a couple of things we're going to start out with, is the a couple of things for cattle producers. And, in the world of acronyms, LRP for the industry is better known as the Livestock Risk Protection Program. That is done by the USDA's Risk Management Agency, but definitely has been an essential tool, especially for cattle producers.
Yeah, it has, Greg. It's just kind of amazed me in the last 10 days since I think it was the Friday before last, that the cattle markets were down the limit. Why I wasn't seeing any commentary on this. This is your price protection. This is the tool that cattle producers can use to try to manage downside price risk. What it is it basically functions as a put option. So a cattle producer can establish a price floor for their cattle without forfeiting the opportunity to benefit from rising market prices. So under the program, a producer buys an LRP insurance policy. That's a specific coverage endorsement. And they choose a coverage price, which is a percentage of the expected ending value, and an insured period anywhere from a quarter of the year, 13 weeks, to a full year, 52 weeks. And that coverage price acts as a guaranteed minimum value for the cattle's market price. So then at the end of the insurance period, the actual market price, based on probably the CME feeder cattle index or some national cash price index, is compared to the coverage price. So if your actual market price drops below the coverage price, then the cattle producer gets an indemnity payment for the difference, which offsets the loss from the price decline. If the price stays high, no payments issued, the producer then sells their cattle at whatever the market price is at that time. So LRP gives a cattle producer flexibility because it can be purchased for small numbers of head. It involves no margin calls. and it allows producers to align their coverage period with their anticipated marketing date. So you get that guaranteed minimum price. You can stabilize your revenue and provides financial security against the volatility of the cattle market. And your coverage prices and premium rates change daily based on the futures market, and they vary significantly based on your choices. But there is a tiered premium subsidy based on your coverage level that you choose. So USDA partners with you on this as the cattle producer, and generally the lower the coverage level, meaning the lower the price floor, the higher the subsidy percentage. So haven't really heard too much about that, but that's the risk protection program that's out there for cattle producers, and it's pretty effective.
And especially if you're a beginning or a veteran farmer and rancher, because you're generally, it sounds like you receive an additional premium subsidy.
Yeah, for example, Greg, if you have a coverage level of 95 to 100%, the federal subsidy is 35%. And if you drop that to, say, 70 to 80% or 70 to 79.99, your federal subsidy is 55%. But if you're a beginning and veteran farmer or rancher, you get an additional 10% premium subsidy on top of the existing federal subsidy. So if you want 95 to 100% coverage, the subsidy is going to be 45%, meaning you're only going to have to pay 55% of the premium cost. So it's a good program. I just haven't heard too much talked about it. So I produced a piece on it. It's going to come out later this week in my Rural Practice Digest.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us. And Roger, let's move over to another thing for the livestock industry. And as we all know, the U.S. beef herd is currently at historically small levels. But talking about bonus depreciation's impact on the herd growth is our next topic of discussion.
Yeah, and this is a big deal going back to the One Big Beautiful Bill Act that increases bonus depreciation, or restores it, I should say, to 100% for assets acquired and placed in service on or after January 20 of this year. And this is a big tool that could really help build the heifer herd. Because purchased breeding stock are generally treated as depreciable assets for tax purposes. Now, typically under makers, they have a 5-year recovery period, but bonus depreciation allows you to write that entire cost of your purchased heifers off in the year that they're purchased and placed in service. Now, with respect to breeding heifer, when are they placed in service? Well, I guess you'd have to ask the bull on that one. But for tax purposes, it's when they become mature. And so the IRS usually doesn't pick too much at that. But if you have a breeding heifer that you purchased that's not mature yet, perhaps they wouldn't become mature in the tax year that you purchased them. And so you couldn't claim bonus on them in that year. But that's kind of a finer point. But the idea of this is that large deduction, that large immediate deduction up front, will allow the taxable income of the cattle rancher to be reduced. It'll reduce the taxable income in the year of purchase, perhaps, if we have maturity that year, which in turn would reduce tax liability, and then those tax savings increases the rancher's available cash flow. So in the context of herd growth, that extra cash can be immediately reinvested into buying more replacement heifers, develop your infrastructure, or cover your operating costs associated with retaining and managing a larger herd. So that is a big deal that got restored to 100%. That's a pretty strong financial incentive to buy high-value breeding stock, which is a direct mechanism for faster herd expansion compared to just solely relying on raising all your replacements, your heifer retention. So I'm glad that got passed, and again, thankful that the bill was passed in July this year. It signed into law on July 4, and we know what the rules are, and we can plan in advance. It's so much better than Congress doing these major tax bills, these reconciliation bills with lots of tax provisions in them in December or even in January of the following year. We've got a nice run-up this year.
A couple of other topics of discussion. One, that, hey, right now, if you need a new car, this is definitely something to keep an eye on, talking about the One Big Beautiful Bill Act. but it also has to do with car loan interest deductions.
Yeah, we've got a new provision in the One Big Beautiful Bill Act that allows you to deduct up to $10,000 of interest related to the purchase of a personal passenger vehicle associated with loans incurred after 2024 and before 29. So this is a 4-year provision. The IRS has now given us guidance just last week and penalty relief for lenders regarding the information that the lenders have to provide to satisfy reporting requirements for the interest that they receive on a covered vehicle. And I had thought earlier, and this is the way I'd been teaching this, that there were going to be forms that the lenders were going to have to file with the IRS and send information returns to the borrower. But that's not the case for 2025. And what they said is there's not going to be any official IRS form that has to be filed with the IRS or the taxpayer, but lenders can meet their reporting requirements by reporting the interest paid on an online portal that the buyer can easily access, or in a regular monthly statement, or on an annual statement that they give to the buyer, or by some other, as it says, similar means designed to provide accurate information to the buyer regarding the interest received. So that's kind of nice for this first transition year as we get used to this. There's not going to be any new forms that have to be filed. It's not going to complicate things. I would add one point that if you're a farmer that's listening in and you're using the 75% business use safe harbor when you buy a pickup for your farm and you buy it this year with a loan, the interest is going to be allocated 75% to your Schedule F, and then the remaining 25% is going to be allowed as a deduction on the new Schedule 1A. So that's going to be different for 2025.
And one other thing or item of discussion that you had a client raised by a client concerning depreciation recapture of a client who had several hog confinement buildings.
Yeah, this is an email question that came in from a practitioner in Iowa, and he said, "Well, I inherited this client, and what he did was he spent $800,000 for a hog confinement building in 2020. And it was set up on depreciation schedule as 10-year property, which is correct. That's a single-purpose ag structure, and then he bonused it, and that was a time when bonus depreciation was 100%. Had been phasing down since then until OBBBA restored it. And so the building's fully depreciated out, and guess what the farmer wants to do in 2025? He wants to sell the building for $800,000. And so the question is, what's the tax ramification of that? Well, it's bad. It's real bad. That the character of that gain, because he has no basis in that, all of that $800,000 is going to be taxed under the recapture rules under Section 1245 as ordinary income. And his question was, well, this is real property. Do I avoid the 1245 recapture rule? The answer is no, because there's a recharacterization rule in the code. So there's no way out of that. That's all going to trigger ordinary income. And so if he's in a 25% tax bracket, you're looking at over $200,000, or just round it off, $200,000 of tax on that sale. And then I sent that response back, and I got the reply. Is there any reply back from the practitioner? Is there any way out of it? I said, well, yeah, if he dies, then you avoid the recapture. But that's probably not something we want to suggest to clients, to avoid tax. But we have to realize that happens with equipment, that happens with single-purpose ag structures. If we were talking about bonus a moment ago, great way to build a herd. But if you're using bonus on assets that you're then going to sell, you've got to watch for depreciation recapture at ordinary income tax rates, which are often much higher than capital gain rates. So it can come back to bite you.
All right, Roger, we're out of time. And I know you've got a busy day today as well. So if people want more information, want to go to your Substack, and to read everything, where can they do that?
That's McEowen, Ag, Law, and Tax, all run together, .substack.com.
All right, sounds good. Roger, as always, appreciate it. Thanks.
Thank you, Greg.
That is Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he joins us today on the Ag Issues program here on 580 WIBW.